for who we are, and I'll obviously touch upon some analytical bits and pieces as well, just to keep it interesting. So you can all see my screen here, I take it. That's all working fine, is it?
Yes, can. And I can see the questions as well. So the questions that come in, I might just interrupt you every now and again, see if we can
Please do.
Questions. But can everybody else see? We should be looking at the blue and white slide signal center. We just use the chat box to give us the heads up that you can see and hear Joe before we launch into it.
Sure.
That would be good. So using the chat box, just to put a little Y or a yes in. Fabulous. Great. Okay, loud and clear. So Joe Neighbour, Chief Investment Officer at Signal Central, I'll hand over to you.
Okay, so first of all, we'll start on the about us. So we set up originally back in 2007, and the primary function of the business at that time was to service hedge funds and banks with analysis on markets, so FX markets, bond markets, commodity markets, and equity markets. And from there, the business has evolved, and we provide analysis to a whole range of people now, from individual traders up to brokers, some of the big retail brokers, and provide sort of consultancy work to a number of financial institutions, providing sort of consultancy on strategy and on markets. And primarily we are technical analysts, so our focus is mainly on price action. There is an element of fundamental analysis that we do as well, but ultimately our main aim of business is to provide clear and concise strategies for all market participants, whether that be beginners or advanced traders. And as I say, primarily using technical analysis to do that. We generate trade ideas, so calls to action on multiple markets and asset classes. Our participation with brokers is really to work alongside those guys to help increase the lifespan of their clients. We've all seen the statistics about how many people lose money when it comes to trading, so we offer our services in conjunction with our partners, really in an effort to increase the lifespan of their clients and give their clients longevity in the markets, and really get them on the right road and the right track when it comes to making money in markets. We provide seamless solutions for this. We embed our platforms and our widgets into broker platforms, but we also provide this analysis to individual traders as well, and deliver that through a number of methods, as I'll come on to shortly. But ultimately, you know, we stand next to people or participants in the market to ensure that they never trade alone, and that there's always someone there that can offer some sort of advice or help or guidance when it comes to taking part in financial markets. So in terms of the people behind it, there's myself on the right hand side, and I'm joined by Ian Coleman and Steve O'Hare. Both of those guys have got over 30 years experience in financial markets. Ian's been involved in FX markets for over 30 years, started off in junior roles, became head of desk, and is our go-to man on all things technical analysis when it comes to you know, all the academic stuff on technical analysis. He knows it all. He's very passionate about it, as too is Steve. He worked back in the old days on the live floor, so he's experienced the change from open outcry to screen-based trading, and made the adaptation to that. And he's also going to be soon lecturing on the circuit for the Society of Technical Analysts, which we're all members of proudly. And then of course got myself on the right.
Yeah.
Sorry?
Yeah, I'll just say I know the STA quite well.
Yeah,
they do a lot of great events.
Indeed,
so that's great news.
So we're delighted to be part of what they offer, and myself as well will be on the panel for lecturers at some stage in the future. I myself have been involved in markets for 16 years now. Started off as a stockbroker around about the time of the financial crisis, so that was good fun. So this isn't my first sort of blip in the market, and obviously we'll learn from those, and that's what makes it fun and interesting. So yeah, that's the team. A wealth of knowledge between us all, and obviously keen to pass that on to people where we can. So our mission and what we're trying to achieve, we are looking to advise people and give them a better chance of a longer and more successful career in trading. We're looking to educate people. We are driven by the fact that most traders will lose money on their own. So we want to be that companion, that trusted person by their side, helping giving some advice and some tips where we can. There's been obviously a huge explosion over the last couple of years of poor quality education providers and signal providers, which we are constantly battling against. All these guys pretending to drive fast cars on social media does make it a little bit difficult for us, and some of them are very good at marketing, to be fair to them, and therefore some of the issues that we face are the fact that we're not necessarily as good at shouting as loud as these guys or making the sort of outlandish promises that these guys do in order to obviously showcase what it is that we do. I mean, it's not always the message people want to hear, that you can't get rich quick trading, which we all know, and I'm sure we've all learned the hard way over a number of years. And the other thing that we try to do is be human experts. So a lot of our competitors in the broking world, the likes of the Trading Centrals and Auto Chartist, all great businesses, but they're very automated, very heavily automated. Whereas we like to sort of add that sort of more discretionary touch to our analysis and provide a human element to that. And in terms of who our product suits, it's suited to everyone from the smallest retail investors to the largest financial institutions. Beginner traders, we're there to sort of guide them, to offer education on the markets that we trade and why we're trading particular markets when we're trading them. A lot of intermediate traders and expert traders also use our analysis as sort of confirmation of their own trading and what they're looking to achieve themselves. And if they get sort of a signal that we post that corresponds with their own analysis, then it kind of adds that extra bit of weight to their trading approach, and can be used in conjunction with what we're doing as well. So unlike most signal providers and what we do in our analysis, we are with our clients and subscribers for the duration of the trade. Once we publish a trade idea, we won't just leave them to it for themselves. We will be there to offer updates throughout the trading day and to ensure, again, that these people aren't alone when they're trading in the markets, and to give them that sort of guidance in line with our own analysis and forecasting. So as I've touched upon, we are primarily technical analysts, and we pride ourselves on keeping the analysis as simple as we possibly can. Clean charts are critical, I think, when it comes to learning, certainly, and understanding and portraying an idea. If you start throwing a load of indicators on a chart, it can all get very messy and people can get lost in those indicators and the noise that you can create on these charts. So our focus mainly is price action, looking at sort of classical technical patterns, using our discretion, our collective experience to find key opportunities in the market to trade them in both directions. Now, how we set up on a daily basis, we actually provide analysis on 35 markets every single day. So every day those market calls are refreshed, and we cover 20 foreign exchange markets, 11 indices, and 4 commodities. And we always have an opinion on every single market at any one time. Now, obviously not 35 markets a day are traded, because that would be, unless you're a robot, that would be quite hard to manage. What we do is we get one bullet essentially each day. We get one call to make on each market. So we are offering our best call at any one point on a market where we think the market will provide the best opportunity to make money. So we can trade long and short in all markets. We may be buying at market or selling at market, or more often than not, we'll be placing limit orders in the market and offering specific entry levels about where we think markets will provide the best opportunity to make money. So all of our analysis comes with a call to action, and there's a roadmap or a trading plan for each of these trading ideas. Each one has a complete exit strategy. So we'll provide you with specific entry levels and where we feel the best opportunity is on that day. We'll provide you with a stop loss of where we feel if that market moves to that we will be wrong, and we will provide 2 take profit levels as well. Now, these ideas are, as I say, refreshed every day. Most of the markets that we provide analysis on will expire at 9 p.m. So we're not looking to carry any sort of overnight risk, and obviously providing a fresh view on the markets the next day. Anything that does get triggered is managed and clients are alerted to either via our widget or via Telegram, and updates are provided throughout the duration of the trade as well. Again, to make sure that people aren't left alone. Once we've sort of given them a signal to get into a market, it would be therefore unfair to sort of walk away and say, right, you're on your own now, it's up to you. Because as we know, not all markets or trade ideas will fill at the entry point and go straight to the target. That's the ideal world. Most will either sort of go a little bit higher towards stop losses or go a little bit lower, but not quite hit the target. So there's nothing wrong with taking profits along the way or taking winners that don't go all the way to the to the targets. You've got to be flexible in your management of these positions, and obviously we have methods and strategies for advising people on that. Now, the other big thing that obviously we're involved in, as a lot of other participants, as I've seen on your working lunch webinars, is education. We feel education is critical and key for everybody to use and to make the most of. And there's plenty of good courses out there, but there's also plenty of bad ones as well. So we aim to obviously teach traders everything we know. We've got a fair amount of experience when it comes to trading markets. We've got a library of online resources. Like yourself, Simon, we're using the Teachable product, which is fantastic for creating courses, and we've got lots of information available on there, and also via our YouTube channel as well, where we're streaming online regularly to groups of people, and of course we are taking part in one-to-one mentoring sessions as well, and offering people various tips on sort of trading plans and how to get started, how to set yourself up as a trader, how to optimize your strategies. We've built lots of tools to optimize our approach. It's something that we're constantly doing as well, and obviously encouraging others to do as well in order to refine your edge and continue along your your path to profitability as a trader. So there's videos here. There's plenty of examples of this that you can check out on YouTube, and I'll stick a link towards that at the end. Now, the delivery of our product, we have a widget which is on the left-hand side, and that's embedded into our dashboard on our website. This is a widget that is often embedded into broker platforms. So you'll see this at some of the UK's leading platforms. They'll take this widget or an API feed of our trading signals and publish them into their own platforms. And as you can see here on the widget, you'll get the name of the market, what class it is, the direction of where we're looking to either buy or sell, entry levels, take profits, stops, the duration of the trade. We often publish some shorter term or swing trade ideas as well as intraday ideas, and of course the status of the ideas, informing you of whether or not that trade is live, waiting to go live, or has been closed out. So we cover intraday timeframes and short-term timeframes. As I said, all of our ideas are added in real time to our widget. This can be easily integrated, and there is possibilities for brokers to white label this product as well and have it in their own branding if they so wish. There is access capabilities from APIs as well if brokers want this, and we've also got all of this available in 13 different languages, and therefore it can be used in multiple countries. And we've also done a bit of work with MT4 and MT5 EAs as well, so that this is available as a plugin, and people can use it via their MT4 platforms as well. So this brings us on to something that's fairly new via Signal Center and is proving very popular with sort of private traders, I guess, people at home who are looking for real-time information on markets, and that is publishing information via the messaging app Telegram. And it's proving to be a really great way of communicating with traders on a real-time basis. And it's allowing us to take the information from our widget or from our back-end database and to basically pump these or pipe these trade ideas into Telegram, and they can therefore be picked up and traded as and when people want to make them, take advantage of those trade ideas. And obviously they're getting the full information there and any updates that would come with it as well. So as you can see here, this was a trade idea from this morning that we published on Sterling Swiss, giving you an update that the trade is now live. We've obviously got a bearish view on that. We're looking to sell at the price of 1.2090. And also what we're doing is providing technical reasoning as to why we believe this is a good trade to take advantage of today. So as I say, we get that one opportunity to trade each market each day, and we are looking for the best opportunities to trade those markets. So in that instance, we traded at that price and we informed our clients or subscribers that the trade had been triggered, and then obviously the parameters are there for all to see. And not only is it good for publishing real-time information and trade ideas, it's also great for communities, and we're doing a reasonably good job of building some useful communities for people to participate in. We're posting in our analysis and our thoughts and our blog posts into these community groups and encouraging other traders to take part in the conversation and get involved. And it's really great sort of communicating with people on a real-time basis, during the day, in conjunction with obviously the analysis we're posting, and getting the feedback and speaking to people about these ideas and helping them make the most of opportunities that present themselves. And also what we are giving people is direct access to us three guys, so myself, Steve and Ian, all that collective knowledge in one place that people can access on a real-time basis. We're happy to sit there and answer any questions that people have, and provide guidance where we can on trading markets. So there's been a big explosion, as I'm sure you're all aware, and all making the most of and taking advantage of video-based analysis. There's been a real explosion in consumer demand for video-based content, and we're seeing that not only with individuals but also as a request from institutions and brokers as well. We have got involved in that where we can. We are live streaming every day at the moment, and have been since October, with our morning podcast, if you like, or morning video, which we've called Talking Bull. We're 122 episodes in now, I believe, and really what this does is just offer a real sort of quick roundup of what's happened on the day previously, what to expect from the day ahead. A lot of talk about charts and running through various bits and pieces, a bit of banter as well between the three of us. And also what we do and have been doing since we started is making live market calls there and then on the morning call. So each day we are running a little challenge between the three of us. So we are making a live call there and then on where we feel the best opportunity to trade is right now, and making a call there and then live on the video. So it's fully time stamped, all there for everybody to see, no hiding behind it, and just calling it as we see it. And we're running those trades until 9 p.m. at night, whereby they're closed off, and then obviously we have another go the next day. And that's proven so far to be very popular, and the results actually have been pretty outstanding, given that we are essentially making these calls with a gun to our head, and making a prediction of where we think the market could go over the next few hours or so. So definitely tune into that if you guys have got time in the morning. It's around about 8:45 in the morning, and it's free. It's streamed via YouTube and various other channels as well. We're trying to get it done on TradingView, but having a few issues with sound. But as I say, YouTube, we're always there at 8:45 every morning. You'll catch all three of us there making some live trade calls. And also weekly analysis, of course. We try and set ourselves up every week, making some videos on where we feel markets will go and how we're looking to set our week up, with running through some charts and just showing people where they can, or how we're looking to set our week up and how they can expect to see the trade ideas start to form in the week ahead. So it's going to start running through some videos. Just see if I can give you a quick snippet of that. It's not going to make it any bigger, unfortunately. But just the three of us mucking about a little bit with some markets and some charts, and giving you some news as well.
Right. Joe, I see there just these example videos. It's analysis on the FTSE, the euro, Japanese yen, Bitcoin, a lot of the majors. You don't specialize. You don't say, well, we just look at these particular indices exclusively. You turn your head to anything that's moving. I guess you're not.
Well, we cover
limited.
our 35 markets that we cover every day. So as I mentioned at the start, we cover 20 different FX markets. So we try and cover the most popular FX markets on a daily basis, and we'll cover sort of the most popular indices as well. So from an index perspective, we are covering in Europe the FTSE, DAX, and the CAC. We do a bit on the South African 40, which is a little bit out there, but there is demand for that from clients, so we cover that. We also cover obviously the three main US indices, so the S&P 500, Nasdaq, and the Dow Jones. And for the Asia Pacific session, we cover the Nikkei, the Hang Seng, China A50, and the ASX 200. We do try and cover a bit of crypto stuff when we can. It tends to be, I suppose, seasonal, because we're not sort of looking at it all the time. But if it's in vogue and it's in the news, then we'll do our best to cover it where we can.
Mm-hmm. And in terms of timeframes that you trade and any sort of risk management for people that might be sort of following you and looking, giving ideas for their own trading, what sort of parameters do you tend to stick to?
Well, I'd say we were multi-time frame analysts, so we're taking into account everything from sort of weekly down to 1 hour when it comes to creating these trade ideas on a daily basis. But obviously, because we are trying to find one good trade in a day, most of the sort of execution, if you like, is done on 1 hour or 4 hour charts. So we're looking for sort of the best levels on a sort of shorter term time frame of 1 to 4 hours. We don't tend to go much lower than that. I mean, in the past, I'm sure we've all dabbled with looking at 1 minute and 5 minute charts, but it's a little bit too hectic for us, I think. And because, as I say, we've only got that one opportunity a day to showcase where we feel is the best opportunity to make money in a market on that day, we sort of spread it out a little bit to sort of the 60-minute charts more often than not.
I know this is the million-dollar question. Do you publish your results? Do you track the performance of the trades anywhere? Have any sort of published performance?
Yeah, so it brings me on to my next slide. So transparency is obviously key in everything that we do. We don't want to be called out as, being, it being fake, but I mean, it's not to say that all of these trades are traded. Signal Centre's been in existence since, PIA First, as we were previously known, was in existence since 2007, and we rebranded in 2018. And these are all the trade calls that we've made since 2018. So there's 5,000 trades there that we've published, and the win rate is there. It's at 45%. I mean, there's a strong focus in everything that we do, really, on risk reward. So never will we post a trade idea that has a risk reward ratio of under 2. So we're always looking to make double the amount that we have at risk. Most of the time, we're looking for sort of anything from 3 to 5 as a risk reward ratio on our trades, which is why we can operate successfully with a win rate at 45%. In terms of overall performance obviously has been a reasonable tick up since the back end of 2019. Obviously we are, and these returns are based on risking 1% of capital per trade, and it's on a compounded basis on the blue line. So if you had a £10,000 account, we are basing this on risking £100 per trade, and then obviously your trade sizes will vary based on how the capital on the account rises or falls.
Is that just the increased volatility? I mean, your performance seems to have taken a tick up over Christmas and New Year, before the crisis even kicked in. So already you were starting to, what do you think accounted for that?
I mean, volatility, if you did an overlay of volatility on the charts, I'm sure that you would see that that's probably when it ticked up. So when you're getting these sort of larger daily ranges, then there's opportunities for bigger returns as a result of that. Obviously potential for more risk as well, don't get me wrong, but I think looking at that, there is probably some evidence that volatility has played a major part in that. But I mean, the thing is with this, of course, because of sort of the business that we operate and the fact that we have to produce a certain amount of analysis each day for our clients, there's obviously markets there that we wouldn't necessarily trade, if it was our own capital. But we are essentially being told to make a prediction on a market every single day, regardless of whether or not we fancy that market or not. We're trying to provide our best level of the day. So with that in mind, I think overall results are pretty steady and pretty good. And of course, there's 35 markets there that we're covering. So there may be certain markets in there that people are just not interested in for whatever reason. And there is the opportunity for you to sort of filter out markets that you're not interested in, and therefore focus on markets that you are interested in. But overall, I think, not too bad, considering.
Very good. Not too bad, is putting it mildly. It looks very encouraging. Just had a question in from, first of all, Bill's asking, what is the YouTube channel to find you on? Is it just at Signal Centre?
Yeah, just if you just type in Signal Centre, you'll find us.
There we are, Signal
And
Centre.
you've got the library of all the Talking Bull episodes that we've done on there. If you wanted to have a flick back and see how they've worked out. I mean, in terms of results on Talking Bull, I can share the spreadsheet on that quickly if people are interested. So this is where we're sort of making gun to the head calls on a daily basis. Can you see that? Can you see the spreadsheet?
Yes.
So sort of the league table of how we're all doing, and we started this back in at the end of October we just based it on £1,000. So if we said if we had £1,000 account and we risked 1% each day and we all made a call, so 3 trades a day, therefore your maximum loss on a day would be 3% potentially. How would we do overall? And lo and behold, it's actually been pretty good. So there's no management on these trades either. We just let them go at 8:45 when we make the calls, and then we just sort of keep track of how they performed the following day.
We can't help but notice that Joe seems to be leading the table there.
Yeah, well, I didn't do that on purpose. That is actually the way it is. I haven't swapped my name out for Ian's.
But you've got the middling, the win rate is less than half, but the pips. You see, that's an interesting thing that people often confuse when they come into trading. They think they need to be winning every trade, but of course you don't. You just have to let the ones that do work for you run, and that's clearly what you've been doing to amass.
It's one of my key things that I'm always keen to get across to people is that if people start telling me I'm trying to make X amount of pips a week, or I made X pips today, it quite frustrates me a little bit, because I mean, yes, pips look good on there, but the reason that's actually so high is because I've had a couple of calls on Bitcoin, which the pip moves are staggering compared to sort of a normal FX market. So I mean, I'm always insistent, really, when people want to sort of engage with this, that they start talking about returns in percentage terms rather than in pips. and focusing on the risk reward ratio of your trades rather than focusing on how many pips you make. Because I've seen evidence where people can have an outstanding pip count, but in terms of what that actually would have meant with correct position sizing and everything else, then their returns are actually nowhere near as good as they're portraying them to be. I don't know if that makes sense. Hopefully it does to you, Simon.
It does, and we hear this from various speakers that we get on as well. It's a great lesson to take home. Roger again is saying, what is the ratio between your fundamental and technical analysis? I know you mentioned earlier that you're probably predominantly technical, but how much attention do you pay to the fundamentals, the politics, that sort of stuff?
Well, I mean, obviously we're all aware of it because we're all market participants and, subscribe to various news services, so very aware of what's happening around us. But I think most of what we do is sort of dictated by the price action, and the reason because, as technical analysts, we assume that everything is sort of assimilated into the price already. So all fundamental factors are kind of in the price, and therefore we're making our assumptions and predictions based on what we're seeing on the charts. So as a ratio, I'd say it's probably 90% technical with a small element of fundamentals. I think if there is a sort of fundamental backdrop, then that sort of is prevalent in the market and people are talking about, we would always look at the charts first, and then if it was a case of sort of trying to portray an idea, then we could kind of add the fundamentals on top, if you like, afterwards. So we would use them as
the big events, the non-farm payrolls, the referendums, elections, things like that. Do you tend to try and avoid these big events then?
Yeah, I mean, on days like that, we are contracted to make these calls on a daily basis. So if we know that there's going to be a big volatile event, then it may be a case that we will put our levels of engagement quite far away from the market. And therefore, if they do get triggered, there would really have to be some sort of extreme move to a support or resistance level that we see as being quite possibly unachievable, on any normal day. But on an event like that, then obviously we can, potentially take advantage of it. But in most instances, our levels will be quite far away from where the market is trading to allow for that volatility. Non-farm payrolls, obviously everybody gets excited about it, and we've started actually doing some live streams on non-farm payrolls. So we are sort of live on YouTube talking to people about non-farm payrolls and sort of watching the number come in and watching the sort of wild swings in price. But most of the time we're quite vocal, especially Steve and Ian with 30 odd years experience in the markets, that trying to trade non-farm payrolls is just you're on the road to losing most of the time. And we always joke about it in the mornings on our podcast, saying that this is the afternoon you should be turning the screens off and going to play golf.
Yeah, indeed, that's the thing. We've got a few questions coming in, but I think we'll pause, let you get back to, because you were giving us a great story there about how the business has come together, how it's all working. So let me allow you to get back to that, and because I've been interrupting all these questions.
That's okay. Fine.
Then we come back. We'll hold these questions for another 10 minutes or so. So
sure. I mean, I'm sort of almost at the end of the story, I suppose, when it comes to Signal Centre, and hopefully people have got a reasonable picture of what it is that we do, and how we sort of look to help market participants. I was going to here just sort of run through some analysis on some bits and pieces that we're looking at, and just sort of give you a flavour of, I suppose, technical skill and how we sort of look at markets and try and, I suppose, form a different view using various different strategies and bits and pieces. I mean, my role within the company, as you said, in Chief Investment Officer, so I do quite a bit more on the sort of investment side and longer term analysis, as well as the intraday stuff, and specifically on equities, actually. So I was going to run through some charts on some equity markets.
That would be great.
Which is obviously where, just sort of give it an idea on where next potentially for equity markets and what I'm actually looking at and the key things I'm looking for. And hopefully, equity markets are something people are looking at the minute. Obviously, they've had a huge rally from these lows that we saw earlier in the year. Pretty much a V-shaped recovery as it stands at the minute. The key question is whether or not this is a full-blown recovery or whether or not it's a bear market rally. And if it is a bear market rally, where are the areas you should be looking to potentially offload some risk and start positioning yourself maybe for another sell-off? So I'll just share my charts. So what I've created here is, I suppose, a derived chart by taking the price of the FTSE 100 and dividing it by the price of UK gilts. Now, this is obviously a stock or equity bond ratio that I've created. So historically, you would expect there to be an inverse correlation between stocks and bonds. So if equities are going up, bonds should be going down. If bonds are going up, equities should be going down. So, a kind of a risk on, risk off approach, I suppose. And I've used the ETFs rather than futures markets or, normal markets, just because they are total return markets and you can get sort of more information from them, I think. So what I have here is a ratio between FTSE 100 and UK gilts, and how you create this on something like TradingView simply is type in the code, divide it then by the other code, and then you'll form this ratio on the chart. So if we just go back here to 2016, this was the low in the ratio, and then we saw this bounce higher. So what that means, when the ratio is moving up, that means stocks are outperforming bonds. So it's best, therefore, that the majority of your capital as an investor is secured in equities, because we're in an environment or an economy that is growing, and it's more favorable to be involved in riskier assets. So therefore, when you see this ratio heading downwards, you're in a scenario where stocks are underperforming bonds, and you're actually better off investing in lower risk assets because they're providing a better return than the riskier asset, if that makes sense. You with me there, Simon?
Yes, I'm sorry. I have my microphone on mute for a second. Yeah, this is great. I do following you.
Okay. So this is the FTSE 100 throughout 2018. So although stocks were actually heading higher in general, and we was definitely very much in a bull market, the actual ratio between bonds and FTSE and bonds was actually declining, suggesting that you would have actually made as good a return, or if not better, in defensive assets than you would have done in the riskier assets from the FTSE 100. FTSE 100 isn't the best market to display this for, because it is weighted and influenced heavily by outside influences that are not correlated to the UK. So, for instance, some of the big heavyweight constituents in the UK are oil companies such as Royal Dutch Shell and BP. And of course, a lot of their revenue and profits are derived in the dollar, and therefore the UK FTSE 100 significantly underperformed, for instance, the US market, because of that dollar influence versus sterling. And obviously, we were going through all the Brexit nonsense at the time as well. So the ratio then obviously completely broke down with a dash towards safer haven assets. So this was obviously the COVID-19 situation really sort of gathered steam in the developed world, and then we saw this big crash in the ratio. So this was a big move or shift to safer haven assets before we then bottomed and have started this recovery process higher. So this is a weekly chart. So what I'm now looking for is when this ratio is going to essentially top out, and when we're going to start showing some evidence that it's time to actually flip out of the risk assets again and start looking towards safer haven assets like bonds or UK gilts if you're a UK investor. So from a technical perspective, I like to use the Fibonacci's as a clue to where retracements could head to. I don't know why the ratios aren't showing on there. Oh, that's annoying. Anyway, so with the blue line is the 38.2% Fibonacci retracement. So that would be the first level that I would be looking for a clue that potentially equity markets are about to top out on this, what I'm still calling a bear market rally, because as you can see here, the trend is still very much down, although this has been quite vicious. Overall, I still think that we are in a bear market, and I would prefer to be more heavily invested in bonds anyway at this stage. But if you're not, and you're looking for an opportunity to unload some risk and have caught some of this rally, then I'll be looking for a move really up to this 38.2% level of this ratio. And then an extension of that, we've got the gap that created there on the 2nd of March and a previous low here for the ratio that we saw on the 20th of June 2016. And then the blue line, we've got the 50% Fibonacci retracement level. So I would think that in here, potentially, if not sooner, would be where you need to start thinking about shifting out some riskier assets and thinking about taking a more defensive stance on your portfolios for the longer term. If we're looking at sort of more shorter term, that weekly candle there is replicated across the board actually in most of the markets that I'm looking at. So you've got this big rejection where you've pushed to new highs, pushed all the way back to form some sort of shooting star candle, which is generally a bearish sign. That's what we saw last week, but there has so far been no follow through on that, and we've actually seen a push up and still further demand for risk assets as it stands. Now I'm going to take a look at the US version of this as well, a little bit more exaggerated. So this is the S&P 500 versus the 20-year Treasury bonds, government Treasury bonds. So as you can see here, since the lows in 2016 on the ratio, it's been a real good environment for owning stocks over bonds, and that's where obviously lots of portfolios would have made lots of money, hopefully. But since really the back end of 2018, there was some evidence that bonds were actually starting to become more attractive, or safer haven assets were actually producing better returns than riskier markets. I mean, S&P obviously is a broader market. If we exclude tech from that, because that's just been absolutely crazy, as I'm sure we've all seen on the Nasdaq 100 and some of the big tech names, they've just been on an absolute tear and arguably looking a bit bubbly. But what we've got here with this ratio is the breakdown again that we saw around about the same time as we saw on the UK version of this chart. The fall down to new lows here, lower than we actually saw on the 2016 low, and now we're in the process of this aggressive bounce back where there's been a shift to riskier assets. So where again is this going to start thinking about rolling over? Well, from a technical perspective, you'd be looking for some previous lows and also some fib levels. So we've got 38.2 that we're crashing into at the moment on the weekly chart. Above that, we've got the 50%, which also lines up with a few of these lows. So potentially, you want to start thinking about offloading some risk in US stocks, probably around about this sort of level on the ratio. And there is obviously the European version of this as well, which is the Stocks 600 versus the European government bonds. Not as prominent with the bull run there on the European stocks. Obviously, Europe in itself has been plagued with various problems in the past, Greece, Italy, and of course Brexit. So not really been much favour for European stockholders in that time. And in fact, holding European government bonds over stocks, you're getting the same sort of return really for much less risk. So not been much to talk of there. But of course, the breakdown here in Europe has been a lot more aggressive than it has in the US stocks. And the bounce back has been as well. Already we've hit that 50% level, which roughly lines up with that low there that we saw in December 2018. So limited upside potential, I think, in European stocks at this stage. And I would now be thinking about, certainly, as we can see there, that shooting star candle on the weekly chart, thinking about offloading some European stocks in favour of some bonds. So overall, thinking here that there is, we're coming potentially close to the end of this bear market rally if the ratio between stocks and bonds is anything to go by. And finally, this is a combination chart of European stocks, so the IMEU ticker versus IUSA, so a broad European index of stocks added together with a broad index of US stocks. This, as we can see, is a weekly chart, and we've seen the crash from the highs. A lot of this has been driven by US predominantly, but we've seen this crash down, and now we're in the process of this recovery. Again, we're into this 50% level on the fib levels. Last week we posted quite an aggressive shooting star candle there, and closed below that 50% fib level. We're above it at the moment, as we have seen again a shift towards riskier assets this week. Obviously a shortened session in the UK this week. We're not going to be in tomorrow, so therefore there's going to be no trading, but the European and US markets still have the potential to close below that level, and if it does, then I would still be in favor of ditching stocks over bonds, I think, at that point. Now, what we have down here is we've added in a relative ratio including the European government bonds and the US 10-year. So a collective view, if you like, of European stocks and bonds put together on a ratio. So this ratio here, when it's going up, is more in favor of owning stocks. When it's going down, is more in favor of owning bonds. And the ratio now, as you can see on a collective basis, is still in recovery mode. We're just about to hit a 38.2% retracement. Above that, just above that, we've got this low from the December 2018, which may act as some form of resistance. And then above that, we have the lows from the August 2019. And we've got this sort of 50% and 38.2% fib levels to target. So in and around here, I think that's when we could be ready for a shift to risk off in markets. So a shift out of equities. People, have gorged on risk assets really since those lows, but there may be, the short squeeze in equities, if you like, or the sort of recovery rally now potentially could be about to run out of steam, would be my take on it. And obviously this all factors into our sort of intraday analysis and our thinking. There's a much bigger plan with all of it. Yeah, hopefully that was a reasonable insight into the sort of things that we're looking at Signal Centre.
It is. Thank you, Joe. That's interesting stuff. Interesting stuff. Let's have a look at some of the questions that have been coming in, just in reverse order. Albert was looking at your spreadsheet with the win-lose ratios, asking, do you have any analysis on the win-loss ratios per asset, for example, cable?
Yes, we can break down all of the performance spreadsheet into individual markets, and if people would like me to share that, then they're very welcome to get in touch directly, and I can provide them with that.
Terrific, thanks. Marguerite, hi. Are bonds riskless?
Good question. And I mean, given obviously the levels of intervention that are going on at the moment, I wouldn't say they are riskless, but I would certainly say they are less risky than equities. I mean, some of these bonds, you could argue, have been trading like equities, and the correlation between the two potentially has broken down in some areas. So I'm certainly not going to say that bonds are riskless, but in a market where there's no interest rates to speak of in investments, you kind of don't want to be invested in cash, so you have to try and find an alternative. And I'm not saying that some of these bonds are the safest alternatives, but for me, it's kind of a one or the other. I'm quite happy to stick my money in, government bonds.
There's two types of bonds, of course. There's government bonds, what we call gilts in the UK, and then there's corporate bonds as well.
Yeah, I mean, the corporate bond market is scary, I think, just due to the sort of levels of debt, and obviously they are tied to the performance of some of these companies as well, and particularly like some of the oil companies that are issuing big bonds, and they would worry me somewhat. So when I talk about bonds, I'm really referring to sort of government treasuries in most instances.
Government-backed bonds. I mean, on that subject, there is talk of issuing sort of corona bonds. Have you seen some of the conversation?
Yeah,
Yeah.
absolutely. Germany seem quite heavily opposed to that because they don't want to be bailing out Europe again. So yeah, I mean, I'm not sure if that will develop. I mean, there's certainly ongoing talks. Um, I think if you are going to invest in government bonds, then I mentioned Europe there, but I'm not sure that would be the safest option. I think anything US or UK related, I think you're probably okay, and I would consider those pretty safe. But Europe, they're going to have to do something pretty drastic, I think, to help out some of the beleaguered economies there.
It's going to take a long time. It's going to take a long time, and of course, but in the UK we've got the joy of Brexit still to come as well. So who knows
Absolutely,
that?
yeah. I've been enjoying the rest from that, but I've got to be honest now. I'm bored of the whole Corona thing, so I'm actually wanting Brexit to come back.
Good. Another question. Deepal saying hi. This is when we were looking again at the spreadsheet, I believe, of the performance. Are all these trades, are these day trades or the intraday trades as well?
So
So
they're all
end of
intraday
day.
trades. Sorry, go on, Simon.
So I guess what Deepak is asking is that the up or down, the profit loss on the day, or does it include all the intraday trades that you've made during that day?
Yeah, so it includes all the trades that we do on a daily basis. So although we produce 35 markets, on average, we might only get triggered on maybe 5 to 10 of those markets on a daily
Hmm.
basis. As I say, we're always looking for the best levels that we can get. So it doesn't always work out that way. We might be looking to sell into a rally or buy into a dip, and if the underlying trend is strong, it may never make those dips back or rallies up to get you filled before it continues to go in the direction that you think. So, there's multiple ways of using the analysis. Obviously, we've got a bias there which sort of defines the trend. So if you're a bull of cable, for instance, and we're looking to buy as well, although we may be looking to buy a dip at a lower level, you're sort of getting that added confirmation that we are with you in your beliefs, and we do think it's going to head higher as well.
Fantastic. Well, Joe, thank you very much indeed. That's about 55 minutes that you've given us for us, and lots of things to think about. Oh, look, Technical Analysis Awards.
Yeah, so last Thursday we were crowned the best FX research at the Technical Analyst Awards for 2020. So that was quite a nice bit of good news in the current times. We were also
Fantastic.
finalists in the best commodity research and the best equity research. And just a couple of notes there on some interesting stuff that we're hoping to get online at Signal Centre in the coming year. Hoping to do a bit more on single stocks. Talking about adding some more sort of courses for advanced traders. And also working on an interesting product at the moment that is more sort of fundamental based, I suppose, using news and sentiment in conjunction with technical analysis. And we're all really excited about that. So that's something else to potentially keep your eye out for from Signal Centre in the coming months.
Fantastic. A lot going on. Great to get that recognition from the Technical Analyst, a great publication, of course. And, sounds interesting, all the stuff still about to happen. So a long way to go, but a great story so far.
Yeah.
What is the best way to, I was going to say, what's the best way to get in touch with you? Here we go. So lots of different channels for social media I can see there.
Yeah, so Telegram is where we are or have become very active in the last few months or so. Obviously, we're all on Twitter, YouTube. Check us out on there for the daily videos. That's all broadcasted free, and there's quite a lot of educational material on there as well. Of course, the website. And if people want to get in touch directly with myself via Twitter or Telegram or email, then very welcome to.
Isn't it funny how we refer to websites now in the same way that we used to refer to snail mail post? It's almost
It's just not the go-to place.
it's about the 5th or 6th place down the line in terms of where people go to make contact. Old-fashioned websites. How about that?
Yeah.
Well, listen, Joe, thank you so much for joining us. It's great to get to know you, great to get to learn a bit more about Signal Centre, and I think everybody here, there we are, Marguerite says thank you and congratulations on the award.
Thank you very much.
I think it's a good story. I hope that some of us will take you up on the offer to get in touch on the social channels, the YouTube channels. I know I found you through the TradingView Stream Centre, which was good, and really repurposing the Talking Bull program every morning, which was great. So all in all, great stuff. And
I really appreciate the opportunity, Simon, and I hope I hope people found it useful. And as I say, feel free to get in touch.
Fantastic. I will. Simon says Graham. So there we are. Please feel free to reach out. Oh, I said it. I don't like that phrase, but I said it. I said it myself. Oh, but feel free to get in touch. So, Joe, and thank you to all of you at the Signal Centre. Super to have you on again at some point in the future. We'll keep in touch and
Absolutely.
going. But in the meantime, I'll take the presenter role back from you.
Lovely.
And we've got another speaker going to come along. So
Okay.
many thanks again
Thank
to
you,
you.
Simon. Cheers.
Fantastic. Great, Joe, says Mark Hopper. Great presentation, says Albert. Thanks very much, says Roger. Fantastic. So I think we all enjoyed that. I think he's got a lot of excellent information. As I say, I just came across the guys on the TradingView stream there, and I thought this is good, and I'm going to see if they would come onto this program, which they did. So thank you to Signal Centre for that. Incidentally, if you haven't yet, I'm talking with the people at TradingView about providing some content for their website. It's an interesting place on the TradingView website. You can go into the streaming center that they've got there, and there's all sorts of traders doing live streams. It's almost like a sort of a targeted YouTube for traders, and quite interesting there. So we'll be doing more about that. I'll bring that to you as well as soon as we get that. But we've also got another online conference coming up in June, which I'll tell you all about, and more in this month. We've got some webinars with Fineco Bank coming up next week as well. But back to today, and I'm pleased to say that we have our next speaker already in the room, Alex Ong from Alex Ong Trading, great friend of ours at Around the Clock Trader. So let me take the microphone off mute for Alex and say good afternoon.
How are
Alex,
you, Sam?
are you there?
I'm good.
Well,
how are you?
very well. All good here, and I'm quite enjoying the lockdown because on top of other reasons of just being less frenetically running around with school runs and the usual daily busyness. It's also been good for me because I've been able to phone everybody up, and I know that you're all at home. I know that you're all there, so it's been hard for people to refuse doing a webinar.
Yeah. Well, I would never hide from you, knowingly.
Of course. In that, I'm very pleased that you are here because it's been a few weeks, I think, since we last did something together, and we always get a tremendous response to your presentations. But you've been working on some new materials, and you've got some new live trading sessions that you're doing as well throughout the week. So let's go and have a look. I know you've put together a special presentation for today based on Marty Schwartz.
Yeah, so it's one of my all-time favorite trading books. And when you have more time, you just, you take another look at some things. And I decided to read his book again and just kind of take a look at a few of the things that he wrote about in his book. And kind of, as I said to you before, we're starting to look at some of the markets through some different eyes, which I thought would be useful to new and retail traders. So I'm looking forward to sharing that today. See what people think.
Absolutely. I'm going to click a button and it's going to take us over to your screen if you accept the challenge. And
let's do this. Okay, hold on. Just got to give access. Okay, can you see my screen or do I need to share it? Where am I?
I think you still need to
Okay.
press a button.
Screen 2.
There we
Can you see
go.
this?
That's it. Well, we're looking at welcome to the web class.
Excellent. Excellent.
Wonderful.
Yeah, that's exactly where we want to be. So should we just
Oh.
jump straight in?
Let's just jump straight in. So Alex Ong, everybody, I'll hand over to you and let's get started. Thank you.
Okay, so welcome everybody to today's web class, and obviously thank you to Simon as always for putting these things on. I think you guys all enjoy it. As Simon and I were just saying, what I'm going to try to do today is talk to you about a trading approach that it's a relatively new one for myself. As I said, it's from one of my all-time favorite books, and one of the things I like about it is it really kind of gives a little bit of clarity to our trading. So as opposed to having to look at and try and decipher, exactly what a trend is, exactly when there's momentum and things like that, it kind of gives us some rules that we can follow that gives us that information. So then all that's really left on the table for us is, making that decision of when to get into or when to get out of the trade, knowing that we've already gone through a step-by-step process for understanding, first of all, which way is the markets or are the markets going, and then are the markets moving with momentum? Because I'm sure we've all been there where we've identified that there's an uptrend and we started to buy in an uptrend but somehow still managed to lose money, or we've identified that there's a downtrend, started to sell in a downtrend but somehow also managed to lose money. And obviously the key is not just to identify the direction that the market's going in, but also to identify those moments when the markets are going to resume or move with momentum in the direction of the trend. Because as we all know, as people that have been looking at the markets for any period of time will understand that even if we are in a downtrend, it's a series of ebbs and flows. So the markets will move down, creating a series of lower highs and lower lows in a downtrend, and higher highs and higher lows in an uptrend. And what we need to make sure that we're doing is that we're not trying to buy in an uptrend during those natural pullbacks in the market. And obviously one of those things is to understand what they are and why they are. But then the other is to identify when that's not the case. So when the momentum is going to resume. And that's what I'm going to attempt to show you in this webinar right here. Okay. So today you're going to learn a very effective Forex trading strategy that you can literally use anywhere and anytime. Okay, so if you want to trade on a beach, from your office, on the train, this is a type of strategy that's actually simple enough to allow you to do it. And what's better is it allows you to trade the daily moves. Okay, so daily price action moves, but by taking a little bit of a step back. So a lot of the time you'll find that traders out there will they'll say that they want to be a day trader because they want the volume of trades. They want to be able to identify trades and get into and out of the market, with high volume. So to take a good number of trades because they believe that will help them build their bank, which obviously in some cases that's true. And they feel that if they're going to look at a daily chart or a 4-hour chart, that means that they're not going to have as many opportunities to trade. And hence to make money. But what this strategy does, is it does look at the longer term charts from a filter perspective, and then we're able to set our orders, okay, also from a longer term perspective, but take advantage of the fact that there are moves on a daily basis. Okay, does that make sense to you all? So we're going to be able to implement this strategy with, let's say, 30 minutes to an hour a day, but still take advantage of the fact that there are daily moves that take place and daily volatility that takes place. Okay, so if any of you still have your email browsers open or anything like that, get rid of it and just give me the next 45 minutes. I promise you're not going to regret it. All right, now, before we get into the strategy itself, let's just identify a few of the common issues that you're all going to experience as traders. And let's just, accept that we all at one point in time have faced at least one of these problems and probably, multiples, many of these problems. Okay, so we're all in the same boat. And that could be you have you have the wrong strategy. So, and I say the wrong strategy here. I don't say, you know, a strategy that's not profitable or a broken strategy or anything like that, because I think at some points we have to understand that, you know, any number of strategies out there can make you money. It's whether that strategy resonates with you and whether you do the necessary work required to understand the strategy and to understand the statistical nature of that strategy to allow you to make money with it. Because every single strategy is going to lose you money. It doesn't matter, you know, how great a strategy it is, or, you know, how well another person does with that particular approach. You know, if you don't put in the work and you don't understand it yourself, then when you fall into those times where the markets aren't right for your particular strategy, then you're going to throw it in the bin and you're going to look for the next one. Okay. A good example of this is I have a friend who used to work for RBS, and they were running a bunch of algorithms, and his job, right, was to look at the markets and to understand when the markets were right for what particular algorithm they were going to use. So if they were going to use an algorithm that took advantage of momentum, he needed to make sure that they identified markets that had momentum. If they were going to use their range trading algorithm, they would need to identify the markets that were conducive to that. So what I'm trying to demonstrate and highlight to you all there is the fact that, you know, even the biggest banks are going to lose money at some point, right? Because when the markets move from one condition to another. So understanding the market condition that you're in and the strategy that's going to work for that market condition is probably one of the most important things. And the idea that we can kind of move from one market condition to the other without taking a loss initially, or, you know, something like that is unrealistic, because we only know that we're in a trending market once there's been some momentum there, and we all only know that we've been in a ranging market once it started to range a little bit. The key is identifying it quick enough to be able to deploy the right strategy at the right time. Okay, so when we're talking about strategy, we have to understand that there are many, many, many different ways that you can make money in these markets. It's just finding something that works for you and also identifying the right market condition to be able to deploy your strategy. Then you've got the things like being undercapitalized. Now, this one, I kind of think it is and it isn't a problem. It used to be a bigger problem than it is today, because in days gone by, there were brokers and you wouldn't be able to necessarily trade position sizes small enough to allow you to trade with, you know, realistic and responsible risk parameters. But in today's day and age, if you feel you're undercapitalized, it's just because you're either trading with the wrong broker or you don't understand leverage and risk, essentially, because you can trade with $100 account with micro lots. So, you know, you're risking like 1 cent per pip, and still trade within sort of decent risk parameters. The problem that I think people have, and the reason I say undercapitalized here, is a lot of the time people are taking positions that are too big for their trading accounts. Okay, so they're fantasizing with this idea of, if I just take 5% risk, then I'll be able to make significantly more profits. And what they end up doing is they put themselves in a position where even if they lose 5 trades in a row, that's 25% of their account, which has a negative impact on them, right? So as traders, we need to understand that we need to be a little bit realistic about the way that we trade and really just use the right risk parameters. So I don't think there's such a thing anymore, particularly in the Forex markets, as being undercapitalized. It's just not understanding your risk. Another one that people complain about is not enough time. Well, the good news is the strategy that I'm going to teach you today literally will require 30 minutes to an hour of your time, depending on how many Forex pairs you're going to look at. And the last one is incorrect mindset, which I think is a massive place that a lot of traders fail. And that's actually what I'm going to talk about first on this webinar here, before we even get into the strategy, because I need you guys to get into the right mindset to understand, you know, how you should approach your trading, to ensure that when I show you the strategy, you know, you're in the right place to understand it and to really take advantage of it. So don't be fooled by randomness. I don't know if any of you guys have read that book. I've got that book on my bookshelf. It's a great one. And what I'm ultimately trying to say here is that don't be fooled by, you know, the amount of losses or wins that you take in any small sample size full of trades. Because as a trader of the FX markets, of the sports markets, of the stock market, okay, whatever it is that you're trading, the result of any one particular trade is going to be random. Okay. So even if I flip a coin, if I go for a coin toss, the result of any, you know, one flip of the coin is going to be random. We have to understand as traders that we have an edge in the market. Okay. And I heard the gentleman before this speaking about their particular strategy and the fact that they only need a 45% win rate to be able to make money. And that really should demonstrate my point here. You know, they're profitable traders with a less than a 50% win rate. But the reason that they're able to make money, and a lot of you potentially wouldn't be able to make money where they can, is that they understand this very concept here. They understand that whilst they have an edge in the market, whatever that may be, you know, the distribution and the sequence of their wins to losses, you know, is impossible to predict. As traders, all we can do is have a strategy or an approach that we know makes money, that we have statistical analysis on, okay, and then execute that trade after trade after trade, without regard to whether it's a win or a loss in the short term, okay? Of course, we need to analyze the results of the trades over a larger sample size full of trades. But if you're looking at 3 trades, 5 trades, 10 trades, okay, there's no way to know whether those 10 trades, even with an 80% win rate, you're not necessarily going to get 8 winning trades and 2 losing trades in a 10 trade lot, so to speak. There's no way to know that, and it probably won't happen like that. What will probably happen is you might get 4 winning trades and 6 losing trades, or 5 winning trades and 5 losing trades. But the point is it's completely random when you're just looking at a small isolated sample size full of trades. As traders, we have to understand that the more we allow, the more trades that we take, the more that we allow our odds to play out. So taking for example, the gentleman that was speaking before this, who's got, you know, a very profitable strategy there with less than a 50% win rate, okay, if you look at the distributions of their wins to losses, you know, it might be that they might get, you know, 4, 5, 6 losing trades and then 1 winning trade, and then another 3 or 4 losing trades and then 2 winning trades. But they're profitable overall and they make money overall. And if some of you are discouraged by a low win rate, you know, one of the most famous traders in the world, I don't know if you guys have heard about the turtle trading project and things like that, and Richard Dennis, you know, they were trend traders at the time and their win rate was just astronomically low. You're looking at 10-20% of their trades made them money, but they made them a lot of money. All right, so they understood what their edge was, and we as traders need to understand what our edge is. Okay, if you go to a casino, you'll see that people at a casino, if they're at any table, you'll see that there are people that will be cheering and high-fiving and celebrating their wins. And you'll see this all over a casino. So let's sit there and, you know, say to ourselves, well, if everybody's winning all over the casino, how the hell do the casinos make money? That's because the casinos understand probabilities. They understand their edge, and they understand that sequencing of wins to losses is impossible to project and predict. But they know that the longer the person sits at that table, they may be high-fiving right now, but if they can get them to sit at that table, at that blackjack table, at that craps table, at that roulette table for long enough, that they will give all of their profits back because the casino has the edge. Okay? And that's how they make their money. They understand this. So yes, people can have a lucky winning streak. They can, you know, win 10 hands in a row, for example. But eventually, if they sit there long enough, because the casino has an edge, they will give all of their money back and the casino will make money. You know, that's why when you go into a casino, they do everything that they can to make sure that you don't keep track of the time. You won't find clocks on the wall in a casino. You'll find that there are no windows. So you don't know what the time of the day is, okay? They pump oxygen into one Vegas anyway. All right, they will bring you free drinks and free foods as long as you're sat there and you're gambling, because they know the longer you are there, the more chance that they have to profit. And that's how we have to look at our trading. Okay, so don't be discouraged by the fact that you might get 1 or 2 losses in a row, because I promise you in the long run, if you have an effective strategy and you execute it properly, you will make money. And to highlight this, what I want you all to do, okay, not now, but after this webinar, I want you all to go through a coin flip scenario. It's something that I've done, is something that I try to get all of the people that I teach to go through. And that is to basically flip a coin 100 times and note down, okay, the sequence: heads, tails, tails, heads, heads, tails, tails. Don't just do how many, but do the sequence of heads and tails, okay? And then what I want you to do is find out how many heads there are and how many tails after 100 flips of the coin. And you'll probably find that it's somewhere like 48 to 52%, something like that. It won't necessarily be exactly 50-50. And maybe it will, but it's unlikely. But it'll be something, 48 to 52, 49, 50, something like that. Okay, so it will be relatively close to 50-50. Then what I want you to do is go and take a sample size of 5 coin flips anywhere. Just randomly look at 5 coin flips in a row and see if the distribution is close to 50-50. And you'll find that some instances they may be, but more often than not, you're going to get it weighted in one, to heads or tails. If you took 10 coin flips in a row, you might see that 7 were heads and 3 were tails. And then a different sample size of coin flips of 10, you would see that there were 7 tails and 3 heads. But it's over the 100 that it all starts to even itself out. Does everybody follow that? So please do that afterwards, even if you don't pay attention to this particular strategy that I'm going to show you here, which you should. But if you don't, please do that, because I promise you, whatever strategy it is that you're going to go and utilize, if you can understand this, and going through this particular exercise right here will help you to do that. If you can understand this, your trading will move on leaps and bounds, regardless of the strategy that you use. All right, sound like a deal? Okay, so the power of 10 strategy, a momentum-based trading strategy that really puts us on the right side of the markets. You see, most traders fail because they do not limit their losses during times that are not right for their trading strategy. We spoke about this at the beginning of the webinar. But what the power of 10 approach does is it ensures that you're on the right side of the market during periods of momentum. The basic premise of the system is to identify not just a trading condition, but a momentum move within a trend, okay? And then to execute a trade in the overall direction of the market. So we identify when the market is trending, and then we identify when we have momentum within that trend, and then we execute a trade according to the trend direction and the momentum direction. All right, and to do this, we're going to adopt an approach that transformed legendary trader and market wizard Marty Schwartz from struggling analyst to one of Wall Street's all-time greats. And if you don't know him, let me just tell you his story very, very quickly, because it should be, it should inspire everybody on here. Whether you're successful, whether you haven't been, whether you're not successful, if you've been trying to do this for a year, if you've been trying to do this for 10 years, you're going to find value in his story. So Marty Schwartz was a smart guy. He loved to gamble. He became an analyst on Wall Street when he left college. So let's say, early 20s, 23, 24, that sort of age. And when he became an analyst, he also tried to trade the markets to make a little bit of money. As an analyst, with all of the information that he had, okay, he failed to make money for a period of about 10 years. Okay, so he couldn't make any money at all as a trader, 10 years trying. So those of you that are on year 8 or year 9 thinking about giving up, just read his story. His actual book is called Pitbull, okay? It's a great book. So 10 years as a struggling analyst, trying to make money as a trader, wasn't able to do it. And then what changed was basically he went to a barbecue where he decided that he needed to change something in his life, and he wanted to take things seriously. And he sat down, he spoke with his wife, and they came up with a plan. And part of that plan, obviously, was to become a successful trader. And part of the plan to become a successful trader was to find a strategy that he could identify with, that he could understand, okay? And hence he could utilize every day in the markets. And the other thing that he had to do was to divorce his ego from his trading. So not to care whether he won or lost, like we were just talking just now, because the win or loss is random, but to worry more about making money. And one of the things that he did, and one of the keys to his success, was being able to identify which direction he should be trading in. So if the market was moving up, not to be trying to sell the market. If the market was moving down, not to be trying to buy the market, because he understood that by doing that, he could automatically eliminate half of the losing trades. If you think about it, at least half. Because if he could stop himself from selling into a rally, okay, or buying into a sell-off, then he's automatically going to eliminate those losing trades from his portfolio. So he's automatically going to start to make a little bit more money, right? I don't know if any of you guys play golf out here, but as a golfer, there's a saying that it's you drive for show, you putt for dough. Now, what that's to say is that, yeah, you can drive a long way, that's just for show, but actually when it comes to the short game, that's where you make your money. And for the avid golfers out there, you'll know that most people, when they get onto the putting green, will kind of take probably on average 3 putts, okay, 2 to 3 putts to get the ball in the hole. Now, if they could just eliminate one of those, they would automatically take 18 shots off of their handicap, which means that they're a better golfer, right? Just by making that one little tweak there, by doing that one little thing. Well, this is the same thing here. By eliminating the possibility for us to trade against the momentum, we're already putting ourselves in a better position to be able to make money, okay? So let's talk about the chart setup. So we're going to use 2 time frames, the daily and the 4-hour time frame. And we're going to apply just one indicator, which is the 10-period exponential moving average. Your chart should look like the charts that I have in front of you on the screen here. On the left-hand side, I've got the 4-hour chart. On the right-hand side, I've got the daily chart. And what I want you just to do, just for a moment, is just to kind of observe what happens to the price when the market is on one side of the moving average. Look at both charts there. The market's on, when the market's above the moving average and it's closed above, more often than not, there are going to be opportunities to make money. So let's say, for example, we got involved in the market over here when the market broke above this moving average and broke structure, indicating the move to the upside. So remember, we're looking for trend and we're looking for momentum, right? We don't just trade one without the other. So if we have trend without momentum, we don't trade it. If we have momentum without the trend, we don't trade it. But look at this here. So when it breaks structure over here, I don't know if you can see my mouse properly. Look at what happens. The market just goes up and up and up and up and up. And regardless of where you bought there, you would have made money. I'm not suggesting that you buy just for the sake of it, all right, because that isn't the entirety of the strategy that I'm going to show you. But I just want you to make these observations, because as technical traders, that's what we have to do. We just need to make observations of how price reacts in certain situations of the chart. And if we can find repeatable price action setups, then we can make money, okay? So we're looking for repeatable patterns. So look at what happens. We buy anywhere here, the market makes us money. So that's our chart setup, one simple indicator. Now here are the rules. I'll give you an overview, then we'll go into it in more detail. The first thing that we want to do is identify the market conditions. So the markets can go up, down, or sideways. And it's our first job to figure out exactly what it is that the market's doing. We need to understand the general direction of the market, the tide of the market. Is the tide coming in or is it going out? Once we have that, we then need to wait to understand when there's momentum in the market. So we wait for the 10 EMA to trigger the momentum, well, not to trigger the momentum, but to highlight the momentum, let's say. So once we know the general direction of the market, we then need to wait for the price to start trading with momentum in that direction. And the 10 EMA highlights this for us. Once we've done that, we then look for our price action entry. Because now that we know the general direction of the market, and we've been alerted to the fact that the price is now trending in that direction, we then look for the price action to trigger us to allow us to take the trade. But what's more important here is that Do you see how we're starting to break things down a little bit and how this might look a little bit different to your trading? So we're going through a series of different quality gates, if you like. First, identify the market condition. Great, we know that the market's moving up. Do we buy because it's moving up? No, of course not. We buy once we understand that there's momentum. So now momentum is trading in the direction of the trend. Excellent. Do we just trade because there's momentum there? No. We still need to wait for the price action to confirm that for us. Now the price action is confirming that the price is going to move in the direction of the trend and in the direction of the momentum. Now we have ourselves a trade set up. And then we just execute our trade, walk away, and wait for it to either hit our profit target or hit our stop loss. So the key to really success, not just with this strategy, but with any strategy, all right, is to execute your plan consistently. And if you do, you will make money trading these markets. But the secret is to become proficient in identifying the right market condition and then having the patience to only enter the trade when the price action tells you to. And if you can do this, you can achieve a win rate of 70%, okay, with a minimum risk to reward ratio of 1:1. So let's look at each step in more detail. Number one, the direction. So it's our job to identify which direction the market's moving in. You know, if it's moving up, down, or sideways. If it's moving up, we'll be looking for opportunities to buy. If it's moving down, we'll be looking for opportunities to sell. And if it's moving sideways, then obviously we are going to do nothing. So how do we identify that? Well, very simply put, a downtrend is a series of lower highs and lower lows. It's characterized by an ebbing and flowing of movement to the downside. So the price will start in the top left-hand corner of the chart and it will finish towards the bottom right-hand corner of the chart. It's really as simple as that, okay? The market will move up and down, but the general direction will be to the downside. An uptrend is the exact opposite. So it's a series of higher highs and higher lows, okay? And basically it's an ebbing and flowing to the upside. So the price will start in the bottom left-hand corner of the chart and finish towards the top right-hand corner of the charts. And then sideways price action is characterized by the fact that there is really no general direction. The market's moving up and down and up and down and down and up. And from the left-hand side of the chart to the right-hand side of the chart, there is no real difference, okay? The highs are pretty much in the same area and the lows are pretty much in the same area. That is a range-bound market and one that we want to stay away from. So once we have that, once we found our direction, we then need something to tell us when the market is trading with momentum in the direction of the overall trend. And for this, we're going to use a 10-period exponential moving average. So if price is above the moving average in an uptrend, we know that we will likely make money if we find a buy trade. If price is below the moving average in a downtrend, we know that we're probably going to have a good chance of making money if we find a sell trade, okay? So what I want you to do here, again, is look at how price reacts once it gets above the 10-period moving average. So following a reversal to the upside, indicating that the most likely direction is up, hopefully that you can see that regardless of where you bought, you would have made money. If I bought here, I would have made money. If I bought here, I would have made money. If I bought here, it went up and up and up and up and up, and then down a little bit, but up, down a little bit, up, up, up. So more or less anywhere on that chart, if you just bought the market, closed your eyes, and did nothing else and woke up the next morning, you would have made money, right? Once we've identified the momentum, but we don't leave it there because actually we can get a little bit more sophisticated with this because we can use targeted entries, all right? So now that we've done all the hard work, we have to identify the overall direction of the market, okay? We have to execute our trade. The previous two charts, we were looking at the daily chart. So to identify the trend and to identify the momentum, we're looking at the daily chart. Now we'll drill down to the 4-hour chart to identify our exact entry point that will allow us to execute a trade at a point that will give us the biggest chance of success with the minimum amount of risk. And we'll use the 4-hour chart to do this. So the entry is very, very simple. And I'm going to give you an example of a downtrend here. An uptrend is basically just exactly the opposite, but you'll be buying through resistance. What we're looking for is simply a temporary pause in the momentum, okay? In the momentum of the market. So if the market is selling off, we want a temporary pause. I'm not looking for a big pullback. How many of you here have been spending years or months or whatever looking for those big, nice pullbacks in the markets in trends, right? You're looking for those big pullbacks, and then after the big pullbacks, you'll sell into that nice big pullback. But you've seen these momentum moves. You've seen these moves in the markets where it just seems to, you're not getting the pullback. It's just going and going and going in the direction that you know that the market's going to go in, but because you don't have your big pullback, you can't get involved in it. And this is what I'm talking about starting to look at the markets in a slightly different way. So to be okay with the fact that we've only got a temporary pause in the market of 3 to 4 candles, you know, or 5 or 6, to say that we don't need a big 10 to 14 candle pullback. We just want momentum in the market. We want the candles to trade towards the bottom of that momentum move, like you get here. And then when the market breaks down again, then you get involved in the move. And then you get a momentum move, and then the market moves sideways a little bit. And then when it breaks down again, you get involved in the move. Okay? Now, I said to you earlier on that just because we're looking at longer term charts doesn't mean we don't get involved in that daily momentum when it takes place. And that's what we're doing right here. Look at this. So we're down to the bottom here. Then we're 4, 8, 12, 16, 20, 24. 24 hours later, we're in a trade. Then 4, 8, 12 hours later, we're in another trade. And then again, another 24 hours later, you're in another trend. What we're doing here, or another trade, sorry. What we're doing here is notice the price action in these candles here. Going nowhere, going nowhere, going nowhere, going nowhere. So if you're trying to day trade this, you're losing money, you're losing money, you're losing money here, you're losing money here, you're losing money here, because it is screwing around. It is ranging and doing sod all that's going to actually make you money. So instead, what we can do is just take a step back and say, yeah, we'll get involved in the daily movements of the market, but only when there are actually daily movements in the market. There's no point in trying to get involved in the daily momentum if there is no momentum. So let's wait for a trigger. And the trigger is for the low in the downtrend or for the high in the uptrend to be taken out of the previous momentum move. It's as simple as that. And it happens again and again and again. And you can see that you make money in all of these instances here. Okay, if you're just going for a one-to-one. Now, you're going to make money all the time? Obviously not. You're going to lose money. You know, obviously, I'm just highlighting what a picture perfect setup looks like here. Okay, I'm going to do it. I'm biased. There are going to be times when you'll lose money, but with this particular strategy here, it's going to be more often than not that you're going to make money. All right. So in terms of the stops and the targets, our stop is placed above the high of the little range that's created when you get involved in the markets. Okay, so go back to this previous slide here. If I sell here, I place my stop above the high there. If I sold here, I place my stop above the high here. If I sold in here, I'd place my stop above the high over here. If I sold here, I'd place my stop above the high here, and so on and so forth. And then the target when you're first starting out, I want to keep things simple for you all. So the target is going to be a very simple one-to-one. If your stop is 100 pips away, your take profit is going to be 100 pips away. And what that will allow you to do is just focus on executing the system correctly. So executing according to your system and not worrying too much about where you should place your targets. We're going to make that very, very simple. Once you get a little bit more experience, then you can look to up things and you can look to run your profits. But to start with, let's just get you making money, right? And putting money into your trading accounts. Once you've done that, then we can get sophisticated and we can look to make more money. Does that make sense to you all? So let's go through a very, very quick trade example. Then I'll open up the floor to any questions because I can see that obviously I've been talking at you for 35 minutes now. So this is a trade in the Aussie dollar. Looking at this chart here, we can see that the Aussie dollar is trending downwards on a daily chart, indicating that our best chance of success will be to sell when the price moves in the direction of the overall trend, right? We then zoom in and wait for momentum. I'm looking at the right-hand side of the chart here. So the market's moving down, pulls up, pulls back, ebbing and flowing as it does. And then here, the market breaks below the 10-period moving average, the same way as it does here and here and here. I'm just using this as an example, okay? So the market breaks below the 10-period moving average here. So now we know that we've got momentum in the direction of the trend because we already identified that the market's moving down. Our entries starts over here at the bottom of every pause. So the pause is there, we sell. The market pauses there, we sell. We sell, we sell. We don't get involved in this market here. Why? Because I said that the price action needs to be towards the bottom of the momentum move. We don't want any big pullback there. Okay, so the market, this big momentum move here, I'm not really interested in that. So let's wait for the next one. We sell again, and then continue selling. And then at the end here, it then turns to the upside, breaks above the moving average, and we have no more momentum, so we don't get involved in the trade. Okay, we put our order just a few pips below the support level, and our stops obviously above the highs, as you can see here. But you can see that all of those trades, apart from this one at the bottom here, would have ended up making us money. And again, I am highlighting the best of the best here because I want you to see what a good trade looks like. But you will have losses, all right? I'm not trying to say that you're only ever going to have wins. You will have losses. You just have to accept that. But with this strategy, you're going to have, more wins than you're going to have losses. I'm absolutely sure of that. So a quick recap of the rules: identify the market condition, wait for the 10 EMA to trigger or to highlight the fact that we've got momentum in the markets, look for price action to trigger an entry, and then execute the trade. Are there any questions? So I'll let Simon start to look at the questions and stuff and let me know what people are asking. While we're doing that, if you just give me a very, very short moment to talk about a unique opportunity, and something I've been working on with Simon here, and for all of you guys at Round the Clock Trader. So if you liked what you saw there, I want to help you become a profitable trader. Obviously, I've given you a strategy which is super profitable. If you're okay with that, fantastic. Run away and just trade that. That's no problem at all. However, if you'd like a little bit of extra help from somebody like myself, you want me to guide you through the process and teach you more about the markets and teach you other strategies, then I'd like to work with you. And today I'm giving 50% off, all right, for both of my trading courses. One is a beginner's course, so step-by-step Forex is more for those of you that are brand new to this and don't even know what support and resistance is. The price action trading course is a lot more detailed. As I said, it's an in-depth study of candles and prices. So what we'll do here is go further than just the basics of the markets and really help you understand why things make money. Okay, why there are trends, why there's momentum, how to identify these things earlier than perhaps you could if you use indicators. And really, it's an advanced price action trading course. It's exactly what it says on the tin. Okay, so the price action trading course, you'll learn to understand how price really moves. You identify opportunities in any type of market. So just now I gave you a strategy for momentum markets. But if you want to understand how to make money in ranging markets, you'll learn that here too. This is suitable for traders who already understand the basics of support and resistance, trend lines, and price action. You'll get unlimited email support from myself, and you'll also get 1 month's free access to the Price Action Trading Club, which is basically a group where every day I'll paste or copy all of my charts that I'm looking at and the trades that I'm looking at, and basically let everybody know what it is so that they can then go and potentially analyze the charts and take the same trades that I'm taking. The step-by-step Forex trading course is perfect for new or struggling traders. You'll learn the basics of how the Forex markets work. You'll learn basic technical analysis techniques. You'll have a solid beginner's trading strategy. Okay, so whereas a price action trading course, I'm teaching you everything to help you identify things. I give you a strategy as well, but I help you identify how things work and understand how things work. The beginner's strategy is really a much more structured approach where it doesn't leave a lot up to your imagination. You just kind of have a very strict set of rules that you need to follow to get into and out of your trade. Obviously, you get email support, and with this, you'll get 1 month's free access to my Forex Inner Circle, which is basically a group where I'll give my weekly analysis. You'll get my video analysis, then we'll have webinars where we'll go through live trades and things like that. So my promise to you is that I will do everything that I can to help you understand what I teach in the course and then help you implement these strategies. this will undoubtedly be the best investment you'll ever make in your trading, because not only will you stop losing money if you're already losing money, but you'll start to make money consistently. Okay, because all of the strategies that I will teach you are battle-tested strategies that do make money in these markets. And you'll be able to join me on live trading sessions where I'll enter, manage, and close trades together with you to give you the confidence to be able to trade, essentially. And you'll get personal access to me to ask any questions that you want whenever you want. So there's my little sales pitch. I hope you all enjoyed it. Now I will open up the floor to any questions you guys have.
Thank you, Alex. I do love that expression, battle-tested strategies. It's very descriptive.
They're the ones that matter, right? The ones that you've actually used in the trenches rather than work, on based on hindsight.
Indeed, and you've been on the battlefield for many years.
Indeed.
See what works, what doesn't work. Listen, we've got great questions coming in. Thank you, everybody. Thank you, Alex, for that presentation as well. It's a very clear. Love the way that you just go through step by step and lay it all out in a very concise, clear manner. And I think everybody will agree with me that great presentation. Good engagement as well, because we've got questions keep appearing in that question box. So we'll see if we can go through them. By the way, first question, someone says, where are the links? Well, I just posted them into the chat box. You should be able to see them there, not the questions box. So if you could just confirm that you can see these questions. I've put two separate links. One is for the Forex step-by-step course, one for the price action course. Just let me know that you can see these links to use them. These are the special links with the discount already worked into the link. So when you go through, it takes 50% off.
Exactly. I should probably let people know that it will be valid for the next 7 days. So after that, then the price will just go back to the regular price. So the coupon's valid for 7 days.
Fair enough. Yeah, absolutely. It's a special round the clock trader campaign this, so thank you for that. Roger, thank you for saying you can see the links. So let's start with your question. He asks, Alex, do you stay out if a trade takes more than 6 bars to trigger?
If the 6 bars start to look like more of a pullback, then I'll look at using a different strategy for getting into the market. So it won't mean that I'm necessarily deterred from trading in the direction of the trend, but this strategy won't be applicable to that. If that makes sense. So this is a momentum-based strategy. Once we go beyond, let's say 2 trading sessions, then the people that were selling the market before in a downtrend aren't necessarily going to be the people that will be selling in the next momentum move. What we're looking for, and the purpose of this strategy here, is to identify a momentum move and to be able to ride on the coattails of those people, the big traders that are moving the markets and making money. And if it goes beyond 6 candles and looks to be more of a pullback, then there are other ways of getting involved in it, but we're just not trading the same move, if that makes any sense. And that's one of the things I like to teach people, is to understand, what moves are we getting involved in here? Who is it that's actually going to move this market? Because once you understand that, it becomes easier to be able to trade those moves.
Thank you. Paul's wanted to know, are you more of a stock or Forex trader?
I don't discriminate against profits. I literally don't care. I'll trade the Forex markets, I'll trade the stock markets, and as you know, I trade the sports markets. So it really depends where the opportunity is at the time. So for example, at the moment, there's a lot of opportunity. There's volatility in the FX markets. There has been some volatility in the stock markets, but I don't necessarily agree with the direction that they've been going over the past month. But when my sort of view changes on the stock market, I'm absolutely going to be all over that market. And then for my very, very short-term trading, I trade the sports markets. So I trade everything.
Yeah, indeed. Has that been quieter recently with obviously no football matches going on?
Yeah, it's been much quieter. I mean, there's been some like Nicaraguan matches and Belarusian matches going on, but the liquidity is so small, it's just pointless. You can't get any sort of meaningful size in there, so you can't make any real money. So, but it's coming
Well,
back. Next week, the Bundesliga is coming back, so there'll be some good opportunities there.
It's interesting, all that football side. Sorry, back to the Forex. Theo asks a good question. He says, can we apply this approach to, say, a 60-minute and a 15-minute chart for more trading opportunities?
You can, but what you have to understand is that you're not necessarily going to get more trading opportunities. You're just going to put yourself at the mercy of the intraday volatility. So as I said, just because it's a daily chart and a 4-hour chart doesn't mean that your trading opportunities will diminish. It just means that we're cutting the crap out of the intraday volatility. But if you want to be involved in that, then absolutely you can apply this to that. Again, going back to the why, because this is very, very important. One of the things I like about the way that this strategy works when you're using the daily and the 4-hour chart is let's just go through the Forex trading sessions for a second so that you can really understand this. You get a momentum move through UK and New York, right? And then you get, let's say, 3-4-hour candles towards the bottom, which are our pause in the momentum. And then the next candle comes in and starts moving in the market in the direction of the momentum. What's happened? Well, what's happened is London and New York had the momentum. They've closed up shops. They haven't taken any additional positions because they've ended their trading day. Asia's come in, which is quite slow. London then comes in the next day and starts to move the markets in the direction of the momentum. So what's happened? The traders from yesterday that were making money still believe that there's an opportunity to make money, and they're going to push the markets in the direction that they made money in yesterday. And if yesterday is any indication of how price is going to go, we're going to make money today as well. If you start to go down to a 60-minute and a 15-minute chart, you're starting to lose that a little bit. Does that make sense?
It does. Okay, thanks, says Theo. That's great. Let's move on to John, who's asking, is there an optimum pair or small number of pairs to trade?
No. So this is a really interesting question. I know that people like statistics on specific pairs and things like that, but we have to remember that every different FX pair is going to trend and it's going to range, it's going to consolidate at some point in time. That's just the nature of the pairs in general. Okay, so there's always going to be a time when there's a pair that's trending. There's always going to be a time when there's a pair that's consolidating. What I would probably say is to stay away from pairs that have the same sort of sentiment built behind them. And what I mean by that is, don't necessarily trade a bunch of risk on pairs again, or risk on currencies against each other. So you might find that something like, the pound Aussie or pairs that are quite correlated to each other, like the Australian dollar and the New Zealand dollar, they're going to move quite close to each other. So the momentum part won't always be there. Having said that, I personally don't care about trading them. That's just for those of you that really kind of want to pinpoint what would be a better pair to trade. That might be a filter that you want to use.
Thank you. Question from Marguerite. Is the exponential moving average more indicative than the simple moving average?
I mean, we're using 10 periods, so the weight isn't going to be as much as if you were using a 100 period moving average. But what the exponential obviously is puts more weight on the recent price action than it does, the first period, so to speak. And all indicators are built based off of price. So I just find that, using things that are slightly quicker work better for me from a psychological perspective, even if from, a real perspective, it doesn't make that much of a difference.
Okay. Anil, what is your email address, please? What is the best email address if people want to send you an email?
So that would be Trade Desk. I'll type it into the thing here. Maybe you can re-put it. Trade
Okay,
Desk.
I'll do it. Yes, it's all right. Trade Desk.
Alex-ong.com.
Alex.
That was wrong. Onog. That's wrong.
Okay.
Let me just, I can't spell my own last name. I wouldn't trust me at all. I can't spell my last name, people. And if I can't do that, then.
Trade Desk at alex-ong.com. I think I put it right there.
That's right.
Yeah. So you can send you an email. Great work, David. Okay, from David is asking, is a 2 to 6 bar pullback rather than a pause acceptable? And then taking a break above or below for a breakout, is it as long as the pullback stays below or above the 10 period moving average?
Yes and no, you could, but you have to understand that what you're doing there is that you're then increasing your risk, because not increasing your risk from a percentage perspective, because that will stay constant, but you're increasing your risk because you're asking the markets to do more than if you just had a pause towards the bottom, because the pullback will imply a larger stop, which will imply a larger target, which will mean that the market needs to do more to get to that target. Whereas if if we're just waiting for a pause, then the stop loss is smaller, which implies obviously a smaller stop loss and a smaller target. So the market doesn't have to do as much to get to your target.
Okay, Assad is gone. Rosemary, does your strategy work for stock indices, FTSE, DAX, and the rest?
Yeah, absolutely. Absolutely. You know, all of this is based on momentum, and you have momentum in, you know, in everything. So absolutely, you can use this for that.
Could you not use a higher moving average to determine trend on the same chart, asks David?
Yes, you can. And I use the 60 period moving average just for like a quick sort of view, so to speak. But obviously this was a 45-minute session, so I couldn't try and include everything, every possible different, you know, indicator, whatever that you could utilize. I just wanted to keep it as simple as possible. But if you want to, yeah, throw a 60 period moving average on there.
Sure. Albert, I see your question. It's on the sports market, so I think we'll leave that though. We'll come back to that. Maybe we'll ask Alex to come back when the sports all take up again, do another webinar, particularly on that. Again, jump over to Theo. If a particular FX currency pair has exceeded its ADR average daily range, and you have evidently missed a prior leg, would you still engage in a continuation setup?
Yes, I would, because remember, we are trading the daily breakout of the session, but we're not trading the intraday. So we're more interested in the overall momentum of the markets rather than taking an intraday trade. So whilst I completely understand your question, and you could utilize that as a filter if you wanted to, I think that in real terms, the amount of losses that you would save yourself by doing that wouldn't necessarily outweigh the winners that you would also miss. You know, I think one thing as traders we try to do is we try to throw so many filters onto our strategies to try and eliminate as many losses as we can, when the reality is that we're always going to suffer losses, and we need to understand that we're going to suffer losses and not try to avoid them, but just accept them. You know, I think I'm probably about to take some losses at the moment on a dollar yen trade that I've taken yesterday, and an Aussie yen trade that I took yesterday. But that doesn't bother me, because I know that the wins are just around the corner. And are there ways that maybe I could have avoided those? If they're, oh, okay, they haven't made me a loss yet. But are there ways that I could have avoided that? Perhaps. But the reality is that then I'd also have to filter out some of the winning trades.
Fantastic, fantastic. Okay, thank you. Okay, thank you, says Leo. Theo, thank you, says David. Thank you, Alex Ong, from Marguerite. And well, thank you from me. I think unless we have any other questions, just the links are there, folks. Sorry, just somebody asking where the links.
Yeah, I don't know if you could like email them. Maybe that might help people if they.
Yeah, I put them on. Now, this is the funny thing with GoToWebinar. Normally it sends the emails out about an hour after the webinar finishes. For some reason, when I went in today to put the content to the minimum time period it was letting me send the follow-up emails was 2 weeks. So
Excellent.
that was, yeah, it's going to be a little bit too far away from us. I will organise, send an email to those. Would everybody like me to send you the links in email? Would that be better? Just give me a little yes if that's the easiest thing for you. We'll get that sent out just this afternoon, because I don't think we can rely on GoToWebinar to do that. Okay, great. Yes, I will do that this afternoon for you. They're valid for a week, I think you said, Alex, at least.
Yeah, exactly. So next Thursday.
Okay, so no need to panic. We'll I'll get onto that. Should have them with you in about an hour or two from now. Great, Alex, thank you so much. It's always good to have you here. I do like your presentations. It's very clear. I can understand everything you say so clearly. It's very, very good. So my thanks to everybody else as well who's also saying their thanks in the chat box.
Thank you very much, everybody. Thank you, Simon. I look forward to speaking to you all again soon then. And if you guys have any questions, let me know.
I know there's interest in some of the other on the football trading stuff that you do as well, but let's do that separately as when we get you back for a special event on that next month.
Yeah,
when
sounds good. Let's do that.
Fantastic. Well, take care. As they say, stay safe. But
yeah,
I think some of the emergency seems to have gone out of things now, and we're all looking forward to getting back to some sort of normality. So enjoy the freedom. I know I am enjoying having a little bit more freedom than we've had in the past. Finally, before we go, Rosemary's asking, what is the website address? Is it just the alex.ong.com?
It's actually better. Yeah, I mean, it's probably better if you go to tradeforaliving.co.uk, which is where all of the FX stuff is.
Yeah, now tradeforaliving.co. Let me repost that link here, Rosemary, for you, so you can see that. There we go. You can see in the link, it's actually the domain name is tradeforaliving.co.uk. So that's the place to go. Wonderful. Okay, Alex, thank you. I'm going to take back the presenter.
Please do. And I will now go and nurse my dollar yen trade, see what's going on there. So thank you very much.
Fantastic. Well, good luck with that, and we'll speak to you again soon.
Take care, everybody. See you soon.
Okay, just before we sign off for this afternoon, my thanks to Alex Ong, who you've just heard, and before Alex we had Joe Neighbour from Signal Centre. So if you missed Joe, please go back onto the recording. We'll be posting it onto the website and Facebook and YouTube and all the other usual places that we can find that. Looking ahead to next week, next Thursday, we've got three great speakers. We've got Charlie Burton from Easy Trader. We've got Alpesh Patel from Alpesh Patel, and we've also got David Bell, the UK Growth Director of Trading View, going to be joining us. So 3 sessions taking place next week from 12 till 2. Hope you can join me then. And as always, I will keep you informed of any updates that we have throughout the week on email and Facebook. Trying to build up the Facebook page. So if you are on Facebook, please go ahead to either at Round the Clock Trader or at London School of Trading. We've got two Facebook pages there. At Round the Clock Trader is the one we're trying to focus on. So please go ahead and give us a like or whatever it is that you do to follow the website, and you'll see the videos posting up there as well. So thanks for your time. Hope you enjoyed it, and God bless.